Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program.
Drew, Meredith, thanks for taking the time out to join me again, mate.
Thanks for having me again a bit earlier on this sunny day.
Yeah, we're recording on Thursday, so we normally record the day before, but because I'm in the new digs, bit of a work in progress, you could say. thought we'd get in a bit earlier, but that's all right. There's a lot of stuff that's dropped in the last week for us to cover. We thought maybe it's a bit of fun to give our best and worst. 2 good reports and company announcements, and 2 bad reports or things we didn't think went down too well. And we'll try and be a bit more concise this time around, huh?
I apologise for that. That's usually my fault.
No. I love it. And we could just talk for hours. But I think for listeners' sake, they'll probably be fed up if we go overboard this time around. So we had a lot of people write into us with different topics and different stories. We're getting some pretty good traction on these videos that we do every week. So if you do want us to continue doing a weekly update, just let us know, write an email to us or send in a comment on YouTube, and maybe I can convince Drew to join me next week. Mate, I think maybe we'll start off with you do one good one bad one. I'll do one good one bad one, and then we go down the list. There's 8 companies to cover, 4 each. So why don't you just jump off with your first?
Perfect. This one's a bit personal for me because you might have seen on the whiteboard last week, PointsBet Holdings. So It's almost I think it was almost a mid cap at about 500 mil. They announced last week that turnover had increased about 100%. So PointsBet does this. It's a sports betting company. They're expanding in the US. Legislation is changing a lot in the US. It's nowhere near where Australia is. Where gambling on sports is everywhere you look. So they're growing quickly over there. Their turnover increased 100%. So they're taking about 1.1 billion in bets. That saw their revenue actually increase 160%, but still only 68 million. But that was all kind of put to the background when they announced this massive deal with NBC Universal. So I think it's the biggest sports channel in America, something like 180 million viewers and 60 million on their app. What we were trying to work it out before this, exactly what the deal means, but basically they're committed to get something like $500 million worth of marketing in return. I think it was 400 in return for giving equity to NBC Universal and leveraging off that to open new accounts, which I think I've been following a few other companies in the US in sports gaming, and the days of it used to be restricted to on-track betting, like the bookies that you see in the movies. So there's a professionalization of that. Did you take a look at it?
Yeah. So obviously it was pretty amazing. Investors' reaction to the NBC deal. I think we're talking about it. I think I mentioned it was up 40% when I saw it, but then you said it ended up 90% after this deal or something like that?
In one day, 90%.
Yeah, which is wild. So we looked at PointsBet a few months ago, because it's kind of like, if you can put the gaming kind of bias aside, it's actually a really impressive business because it's kind of a digital platform. It has a really early mover advantage in some of the key states. And it got beaten up pretty heavily by investors during March. So interesting business, but this deal, we're trying to work it out, is effectively marketing for equity. And there's a whole chunk of options that come with the deal, kind of like this sweetener. Like, you can understand from NBC's perspective, they've got all of this, broadcasting and these eyeballs on them. And PointsBet comes along and says, we could be your gaming partner, put us in there, and then you can share in our share price appreciation. But there's this huge chunk of options in there. And we talked about it. Let's just say the share price stayed where it is. They're already in the money, even though they expire in 5 years.
In one day.
In one day. So that's a huge upside for NBC. Obviously, it's strategic for PointsBet because they've obviously crunched the numbers. They've got, an ROI from getting these new users on board. But it seems to make sense because both parties will benefit significantly. The thing that followed, which we haven't really talked about yet, is the capital raise.
Yeah.
And that's pretty substantial, right?
Yeah, I think they've gone straight to market for about 300 million. So somehow they have to fund the expansion, the ability to take on. They've only got 111,000 active clients at the moment, and if you're in front of 180 million eyes, plus all the other markets that they're in, including Australia, they're going to need a lot of money to and probably increase staff quite quickly, even if they've got good tech. So,
yeah.
Interestingly, it looks to be priced at 650, so the day before price. Which given it's 13, I don't think many people won't be taking it up.
Yeah.
But it's in a trading hold at the moment.
Well, that's interesting because it's a $2 billion company now with the current share price. So if it's a $300 million raise at virtually half the price, you'd be crazy not to take it up. But I imagine that this being a strategic deal, it's not going to fall significantly. Like I would imagine, this is like thumb suck to the air. Like I can't imagine this going back to $6.50 or probably even below $8. That's just kind of my gut feel. So even still, I would imagine there'd be some pretty good, premium for you to take up the rights there, right?
Yeah, definitely. You don't see these kind of business-changing deals very often, so it's hard to price what it's going to look like afterwards. Yeah. I think even $10 might be pushing it given the momentum that's come out of this. And yeah, they've got quite a unique way. It's almost a more professional type of gambling. The way that they look at it with this spread betting. So
yeah, and the thing is,
market.
I mentioned the options there as if it was a bit cynical, and it's good for NBC for sure. But if they do exercise the options, that's more cash in the bank for PointsBet. So there's I guess multiple benefits to that structure, and it does mean that there has to be upside for shareholders for NBC to benefit.
And they'll be everywhere too. So I think they'll be in the app. They'll be on every game of basketball, like we see at the footy at the moment. They are already signed up with Channel 7 and Fox Sports in Australia too. So it's getting really getting the momentum going. For
sure, mate. It's good business. Maybe we'll touch base on it in a few weeks. But from something that you were really excited to read about and to see, maybe not. Maybe you would have liked to have bought it sooner. But what's a company that probably you didn't really take a liking to when you saw the report?
I have had a bias against it for a while. I think we both discussed this. Yep. QBE Insurance. Mm-hmm. I called it a kangaroo stock. So I think I've held it once upon a time, maybe 5 or 10 years ago. But basically, it just goes up and down. It's up to 15, down to 8, up to 12, down to 7. They seem to do a capital raising every few years. Result was a first half loss of 700 million, down from a profit of 500 million in 2019 first half. A big chunk of that was COVID-19, whether it's claims or costs. And another part was, there's 3 parts of an insurance company. There's sales, there's claims, and there's investments. They have to keep enough in their investments to fund the potential claims. With interest rates so low, they have to hold a lot more in investments to cover that. So they had to provision another $330 million in that area. The result was a dividend cut, so they're paying a 4-cent dividend. Most of that was flagged previously. And the loss was about 300 million more than a couple of brokers were expecting. So as a real comparison, the dividend in February before COVID took off was supposed to be 50 cents for the year. So,
jeez, yeah, wow,
halving.
And this is the thing, this is a business that we talked about this. I did own it quite a few years ago. In fact, I was crazy enough to buy warrants over the shares. But quite a while ago, I thought maybe this thing could turn around if interest rates come back up, and that float, which I guess Warren Buffett has popularized, and then Mark Alcorp in the US as well. If interest rates go up, the float is worth a lot more, and it's just money for jam. But when it goes the other way, it's the opposite effect. But I was saying, I can't understand why anyone would invest in QBE Insurance shares. To me, it is just completely not investment grade. there's obviously a reason for the business to exist and people could make money from it. But as a long-term investor, if you want consistent dividends, you don't go with this type of insurer. And if you want capital appreciation, you'd have to have a pretty strong level of conviction, a pretty high level of conviction that management can actually execute after so many attempts to try and get this thing going again. I just think, yeah, I would just avoid.
Even more negative than I am.
Yeah, maybe I'm probably a bit scalded from my experience with it, but I don't know. I just think if you're looking for insurers, maybe look at one of the other ones that does a bit more banking or something like that, where it's kind of regulated into profitability. Whereas with this insurer, it's clunky. There's so many moving parts. It's hard to
natural disaster risk as well. Bushfires.
Yeah. I often hear the phrase, Drew, that if you're going to buy an insurer, buy it in a bad year, and that's probably why you get the
kangaroos and then a capital raising.
That's it. Yeah. But the thing is, there haven't been many good years, and they haven't strung together very often for QBE. So, if it's probably one of those ones, be there for a good time, not a long time, if it's possible. So
ride the 30% up and then get off.
Yeah, then just jump off. Thank you very much. But anyway, that's to be honest, with the non-cash write-downs, you would expect to see that with COVID being the way it is, in particular in the US. Cool. Okay, so I'm going to mix it up with my two. My first winner is not from Australia, so I thought I'd mix this up a bit. But I think it's a really good example of the cashless economy and society and moving away from physical cash into payments and that type of thing, because we talked about this last week. It's PayPal. So PayPal, obviously being a US company, reported its quarterly, its second quarter. I've got some numbers here. And keep in mind, this is a huge company. If this was on the ASX, it'd probably be the biggest, if not one of the biggest companies in Australia. Total payment volume. So we all know PayPal does online transactions, right? $222 billion, up 30%. And that was despite a 60% drop-off in volumes from travel and events.
What's Afterpay? It's 11 billion, isn't it?
Yeah, something like that. Yeah. And so, I mean, it's quite different. With PayPal, a lot of merchants or a lot of businesses use PayPal for large, secure transactions. So with PayPal, I don't know, this is going off the top of my head, but the numbers that I last saw were an average, a customer transacts through PayPal on average 39 times a year. So whereas with Afterpay, you could probably transact 39 times a week if you're just buying smaller items and whatever you want to do. Whereas with PayPal, it's kind of, like, for example, our business, when we take investment subscriptions and people pay for courses and all that type of stuff, you would do PayPal, but you don't have to then go and do it again next week or whatever.
And it's more global too, isn't it? So smaller, even emerging countries are using PayPal.
Yep. And this is the really interesting thing that probably people don't appreciate unless you look closely at PayPal. There's the PayPal core brand, PayPal.com and all that type of stuff. But it owns things like Braintree, Venmo, which is a huge peer-to-peer, like kind of cash transfer app in the US. It's pretty much everywhere. It's pretty much the app you would use. And then it's got strategic stakes in businesses like Mercado Libre, which is the Latin American version of Amazon. And it's got a few others. Like it's had a stake in Uber. So there's a lot of, equity accounted optionality in it. Equity accounting, but basically it's not reflected in profit and loss like you normally would see. Anyway, we're going on this whole rant here.
None of them pay dividends, so there's no rent or there's no income from them.
There's nothing yet. So it's just really like, what is the carrying value of this and yada, yada, yada. So 21.3 net new active accounts. That's 21.3 million net new active accounts. So you think about, like, people might be inclined to think, PayPal's kind of the thing that people used on eBay in the 2000s. Well, that's a very, very, very small part of the business, and it is just exploding. So this was the strongest growth it's ever experienced, since it was founded. So pretty impressive. 346 million accounts. The thing I love about PayPal, sorry, go on.
People have been forced to use it basically, and probably even the older crowds that are going on to Amazon and eBay for the first time, it's more comfortable using PayPal than it is putting your credit card details directly into a website, probably.
Yep, absolutely. And that's the thing. So I've got a note in here, which is that for me, PayPal's still, for most people who are conservative with online transactions, it's definitely the preferred choice at the checkout when you're in that, talking about that 30 plus demographic, because It's the people that have been on the
I'm 30
internet a
plus.
while. Hey, I'm about to turn 30, so I guess I'm in that demographic. As a shareholder, I use it quite a bit. So, but let's say, for example, if you had a $1,000 transaction, I would be much more inclined to spend through PayPal, securely transact that way than with some, other kind of like just credit card on a website that I haven't been to before or something like that. So it makes a lot of sense, and it still has a lot of relevance is what I mean to say. So just to cap it off, $2.2 billion of free cash flow, up 112%, beat Wall Street on every metric. It's accelerating its omni-channel push. So this is something that we're talking about when we talk about Afterpay and Zip and Square in the US and even Apple Pay and Google Pay is, there's online and then there's, in-store payments. And omni-channel is kind of everything that goes between. So online, at the, when you get your coffee, you tap and go, or, when you're doing something in a Kmart store, whatever it might be, omni-channel means you're going every route to market. And PayPal started with online, obviously, and now it's starting to expand down into the more like physical presence, point of sale type stuff. So it's really interesting, and which is really important to our listeners who own Afterpay shares. Obviously, some of the buy now, pay later businesses have taken a bit of a hiding this past week, and that's a lot of people have attributed to that to PayPal expanding into installments. So
seems more like a defensive move though from PayPal, not something they intend to ramp up. I don't think they want to be a credit company like BNPL that would make as much margin. I wouldn't think.
No, and this is the thing. I think there's a lot of talk about with these the cash basket companies, so the companies that are cashless baskets, that don't transact in cash, but are the future of payments. We'll probably see a lot of consolidation in the industry over a long period of time, and whether the businesses that started online take over the businesses that are in the physical stores, or whether it happens the other way, or how they overlap. This is going to be really interesting to see how it plays out over time. I want exposure to this sector. I really do. I've got it in multiple forms. But I think for PayPal, it's so big. The thing here is it just wants to have that optionality, right? If people can already, if we both had Venmo, I could send money to you instantly to split the bill for whatever. You could buy a subscription, or, I could buy something from you, and it can do it all. So why not just push it into installments as well? Kind of makes sense.
They charge the same fees, or just about, don't they? PayPal's not cheap for merchants, something like 5% as well.
Yeah, it varies. So when you talk about like payment gateways, and like for us, we take payments two ways. One is through PayPal, and the other one's through Stripe, which is a private company, which must be brilliant, I imagine. They're pretty much like for like, but you do feel it. If you I don't know, maybe it's 3% or so, but you do feel it if you're doing a lot of small transactions. 30 cents covers your visas and all that type of stuff that PayPal pays away, but then all the other percentage is just money for jam for them, because it's just all margin. There's really no cost of goods sold in these businesses other than the railways of payments, which is Visa and MasterCard. So it hurts merchants to an extent. So the buy now, pay later trend could actually be interesting. But I think as a merchant myself, I prefer PayPal because I know what I have to pay. Whereas, some of these other buy now, pay later businesses, it's a bit tough because it kind of changes. There's no really rhyme or reason to what the price would be. So we've heard of, in some instances, of the large retailers getting a much smaller margin, which you'd expect, than some of these fast followers and smaller emerging merchants that pay a much greater margin when they use these services. So interesting business. I think PayPal's a bit exy, to be honest, but I still own it and I'm happy to own it. So yeah.
It's tough. What metric is it expensive on? PE, every single one against the price that involves price or earnings.
Well, that's the thing. So we did a DCF, our discounted cash flow, which, I like to think that I'm pretty conservative, but I think everyone does. And our DCF is about $170 to $185 fair value. And so, if you buy at fair value, if you're an investor and you buy at fair value, you're effectively getting the cost of capital as your return. That's what you're assuming going forward. Unless it beats your expectations, then you'll get more upside. But, if you're using a discount rate, this is a bit geeky, but if you're using a discount rate of 8% or 10% for a business like this, so 8%, you buy at fair value. You're effectively saying, I'm happy to take an 8% return if all of my forecasts are right.
Yeah.
And so maybe you take that bet because you think it's more likely to do better than my expectations, and it's doing buybacks, and it's got heaps of cash, and it's got optionality from these equity adjusted investments, which I didn't put a value on, by the way. So, there would be a reason to own it, and I still own it. I'd be happy to have it as a small part of my portfolio.
Makes sense.
Yep. Okay. So why don't I just jump in? I've got an easy, low-hanging fruit, quite controversial one. I think we had plenty of feedback to last week's Buy Now, Pay Later sector review. The banks are probably my losers here in Australia. Just broad strokes. I've been knocking them for so long that I sound like a broken record, but every time they've proved me wrong. So, this is probably one of those bad years, maybe two of those bad years in a row, following 10 really good years from the banks, following 3 decades, you could say. So the banks, we saw a lot of dividends cut. We saw a spike in provisions. I still don't think those provisions are enough. I think we'll see more. Before COVID, provisions or credit losses were the lowest they've been in for as long as I can remember. And so you're kind of going from a perfect operating environment to potentially the worst we've seen in 30 years. Probably is the worst.
And the worst of the pain's probably coming next year too.
Yeah.
GDP yesterday was down 7%. But it's clear that JobKeeper and all these other things are doing good work so far. Savings rate went from 6 to 20%. So people are, getting their capital together just in case. And wouldn't it do, depending on how long the borders are closed, there's probably going to be more unemployment as we enter next year and beyond JobKeeper. So
and no migration.
Yeah, no migration for who knows how long.
Yeah. Those things combined, I think I agree. There's probably more pain in store. I think this is probably the tip of things to come. I think we've spoken about it before. The banks having more capital on their balance sheet isn't such a bad thing because it means they have more optionality going forward. But
bad for returns and profits, but not for shareholders. It means you're more secure and you don't need to raise more capital.
Yeah, and you would expect them to do that going forward. And I think we said this before, but in my opinion, the banks were almost looking for an excuse to cut dividends anyway. So you're probably not as steep as they would have liked as they did. But I say this is one of my losers for the reporting season, but these are businesses that I do not expect to go out of business. I think they're essential, and I think they'll be back to paying more dividends more often in the future. So it's just kind of one of those things where it just takes a breather.
I think most people would agree on that one too. So anyone missing some dividends?
Yeah. How about you, mate?
I'm back to the most boring one that I always threaten to put in each week. So on the one side, QBE, we hate insurance. The other side is AMP. It was down to
two great ones.
We got to do blue chip some weeks. Or not blue chip. I won't call it a blue chip, but large caps some weeks. I think the share price got down to about $1.10 in the middle of March, and it's back up to about $1.60 at the moment, so almost 50% from the bottom. Reported a 42% fall in underlying profit, but there was still 150 million, and a bit of that came from everything. So they've got a wealth management division that has superannuation platforms like North. They've got a financial advisor network. They own AMP Capital, which is $200 billion infrastructure and property manager. And they've got their own bank that's growing faster than most of the major banks as well. So they reported $149 million profit versus a $130 million loss expected, and then paid a special dividend after selling their insurance division for $3 billion last year, which now looks like a prescient call, even though it was called out and the company was sold off when they did it. So.
And because I was looking at this, I did not expect a dividend at all. So that was really impressive. I think that caught a lot of people off guard. Also, there was a small buyback announced, right?
Yeah, small buyback. Nothing overly accretive, I wouldn't think. The big probably announcement in there was they've still got something like 1.4 billion in excess capital. They obviously don't want to pay it all out at the same time, but a dividend after not having one since 2018, sent the share price up at I think 5 or 6% on the day. And then more recently, there was obvious culture issues. They were on the front page, the back page, every other page of the paper. It was, I'm a shareholder, and it's kind of, that was almost enough. But finally, they cleared out their board. They kind of, without being negative, the old bankers, are gone, replaced. The CEO does seem like he understands the issue, but the board was still a board from the CBA back in 1999.
Yeah,
so,
right.
I saw that as a huge positive. And then yesterday they announced that they're reviewing. They've received acquisition proposals from private equity or other groups for different parts of their business. So I think kind of your way, if you go sum of the parts on this, it adds up to more than $1.60 a share if everything was sold. What were your thoughts on that?
Yeah, I mean, I'm not up to date with the rumours here, but I know that there are parts of AMP which people would find extremely valuable. I think the thing that's always amazed me, right, is AMP gets raked over the coals every 6 to 12 months or even more frequently. And there's still so much money inside the AMP Capital business.
Yeah.
You'd think that brand would just get hammered and then people would just be withdrawing their money, but they're not. And so that tells you of one of two things, I guess. It's either a really sticky business, like people, infrastructure funds and what have you, having an asset management, that's really sticky, or people are just kind of careless or lazy, or they're just clever. So I think it's the former. I think this is a sticky business. I think it's a pretty good business, that AMP Capital. If it's split off from the rest of the AMP network, I'd probably be more happy to own AMP Capital. I definitely would be.
Yeah.
So I think that's net positive. I think everything that I've seen in the past year has been really positive. I think that window, the past year, I think the Royal Commission was just before that. So everything since then has been positive, and that's probably the shake-up that it needed. So I think, it caught me off guard. I was just expecting it to be like the QBE, just another dog report that comes out and you just think, whatever, back at the bottom of the pile. But this was actually a really good surprise. Yeah. So
we actually met with the AMP Capital a few weeks ago. One of their assets is Melbourne Airport, and they manage a portion of the stake on behalf of the Future Fund. So it's kind of this huge direct assets. They've got some airports in Europe as well that they manage. So 200 billion. And the big thing was they took the remaining 15%. They bought that back from, I think it was the Japanese investment bank. So they own 100% of AMP Capital. I see it going one of two ways. You combine an AMP bank with AMP Capital and you have a mini Macquarie or a Macquarie group, or you go the other way, you combine a bank with the planning and you get rid of the funds management, which is kind of the main conflict that they have. So they've got plenty of options. It doesn't mean you sell everything.
No, you wouldn't want them to.
Yeah, exactly.
But
I thought that was,
that's a really good report, I think, considering like what we've seen in the financial services space and the large cap space recently.
Yeah. And a dividend, that's always the best part.
Oh yeah, special dividend. It's a special, so it's got to be good.
That means they can cancel it next year.
Yeah. What about losers, mate?
I've been looking at this for a while. Kind of fits with that retail theme we were talking about. Scentre Group, which owns the Westfield shopping centres, 42 shopping centres, $35 billion worth. Their operating profit was 360 million, so it was about not quite half of last year. The big announcement was $4 billion worth of property devaluations, which is a 10% reduction on their carrying value. The question is that enough? The share price is still down something like 50 or 60% from pre-COVID. Rents are still, I think they're only 70% of rent collected in the 6 months. So the way you value a property is based on the rent. Are you getting that rent back? How much of the rent's going to come in? Are you renegotiating leases? So I've got some kind of concerns on the cap rate. If everyone knows how the cap rate works, is like a simple way to value a property. The most of the properties are somewhere in between 5 and 6% cap rates. With interest rates low, it seemed appropriate. The risk is that, higher vacancies in a shopping centre mean people aren't willing to pay the same price for that shopping centre. And then they haven't done a capital raising yet, and that kind of concerns me.
Yeah, maybe they think they can weather it for a few more months and just get some good news. Maybe that's what happens. But I think, we talked about this maybe 2 or 3 weeks ago now when we talked about the retailers, and some of the retailers naturally are pushing back against Westfield or Scentre Group to say, hey, the government said this, you're supposed to work with us. And I think anyone that's been around shopping centre management or knows how these businesses run, they would know that it's a very risky strategy to start a retail business in a shopping centre because they're long leases, they're extremely expensive, and the businesses effectively are like the puppeteer. They can see what's going into your till. They can adjust their rent accordingly.
They hold the keys as well.
They hold the keys. There's pretty much no way in and out of it other than their way. And I saw the 70% and then the 80% in June and July of gross billings, and I thought it's probably pretty good, to be honest. It's probably better than I thought, considering Victoria. I mean, I think we've become a bit parochial here, and we think that everyone else in the world is in stage 4 restrictions, but no, it's just us. But I think considering that we are in the restrictions that we're in here in Victoria, which is one of its biggest markets, 80% was pretty good for those 2 months. So
I was pretty interested that even in March and April in Australia, there was still 43% of normal capacity in the shopping centres. It was something like 0 in New Zealand at the same time. So
goes to show the Aussies love to get out to the shopping centre. It's crazy. Yeah, you see the news footage of the shopping centres around here in Melbourne, and it's like nothing's changed. It's. I mean, this is a business that, like the banks, I guess, we could see a bit more. We likely will see more pain to come, whether that's through capital raising, just lower revaluations, higher cap rates, whatever it might be. Who knows what comes next specifically? But you would have to say, broad strokes, it's pretty tough outlook for the next 12 to 24 months. Yeah,
and the share price is telling us something. It's not recovering very quickly, so it's obviously worse than we think.
Yep, totally. Cool. Well, that's another large cap, you would say. I'm going to drop it straight down, straight into a small cap, and that small cap is a company called RPM Global, which is a business that I've covered before in one of the podcasts that I did for the Australian Investors podcast. And RPM Global, for those that aren't familiar with it, it's a $250 to $300 million business now. So it's got a lot of legacy assets that are in mining advisory and consulting. So you would go to them for, I guess, advice on where to build a mine, how to build it, if I should buy this mine, how much should I pay for like professional valuations and that type of thing. But in about 2012, a guy called Richard Matthews moved into the company, effectively took over as CEO not long after, and bought a heap of shares in the business because the business had this consulting arm, which was the predominant part of the business. And you know as well as I do, Drew, when you've got a consulting or labor-intensive business, it can be quite hard to earn pretty good margins from that. But then you couple that with the mining sector, which is going through these vicious peaks and troughs, and it becomes very lumpy. But what he saw was this adjunct business to that main business, which was the software business and the ability to provide technology solutions. And what he did was he invested again and again and again over the past 7 years or so into developing new content. He would go out and employ software engineers who might have otherwise ended up in things like gaming and like video games and that type of stuff. And he got them to build augmented reality mining software that planners could use to kind of simulate different parts of the mine and what have you. And it's anyway, the business has gone through this 7-year development cycle, and it's now starting to offer these subscriptions to all different mining clients throughout the world on a subscription basis. So taking away the once-off payments, the perpetual licenses, like think of
Adobe or Microsoft.
Think of the old CD-ROM where you would install the software and you'd use it. Adobe and Microsoft made that transition 5 or more years ago. They're doing the same thing. Obviously, it doesn't suit all clients when you're out in the wilderness trying to build a mine to have an internet connection. But for the most part, RPM reported net revenue up just 1% to $74 million. So not a great, I guess, top-line figure when you think about it. But if you dig a little deeper, and this is the beauty of RPM, once-off software sales, so that perpetual license which you just spoke about, down 43% to 6.9 million. And software subscriptions, which are typically sold on 3 to 5 year contracts, up 317% to 10 million. So it's coming off a low base, but it's coming up very quickly.
Switched it quickly, replaced that one off very quickly.
Yeah. And this was the year. So I bought shares maybe a year and a half, 2 years ago. maybe a year and a half ago. And I was really worried about this year's result because this is the crucial year where subscriptions should take over perpetual licenses or thereabouts. And I was worried that it was going to be a very lumpy result, but it was actually really consistent and really strong. Free cash flow, depending on how you calculate it, over $10 million for a $250 million business, software, growing, pretty reasonable valuation, which I'll get to. So it's got, which is a really interesting one, $34 million of contracted subscriptions already. And that was just sold during the year. So that's pretty impressive, up from 10 million the year before. So that effectively says we've baked in future subscription growth. Really impressive. Next one, 28 new customers signed up during the year from 15 the year before, and a lot of new and existing customers taking up additional products. So that cross-sell opportunity. So once they're in the door, did you know we also have this? It's a really impressive thing.
Mining as a service. Is this MAAS?
Yeah, effectively, yeah. So when I did some numbers, this was last week, $290 million market cap. It's got 40 million of cash in the bank, so that's pretty impressive. Nearly 20% of its market cap in cash. If you exclude that, looks like it's on an enterprise value to free cash flow multiple of around about 18 to 20 times. So for a business, small part of a portfolio, like I'm really happy to hold it. So interesting business, reported well. This was probably the toughest period for it to report in. There's a bit of uncertainty with how do you go about selling to mining clients without conferences? How do you go about employing or retraining staff that were in advisory and consulting, or like what do you do with that mix? So there's a few uncertainties, lots of risk there. It's volatile business, so keep that in mind. So that was probably my better report for the reporting season, one of my best, I would say. Now to go to one which is not so good, which I still own. So hopefully this shows my humility. And it's a business called Rask Australia. It does infant formula and goat milk, which, by the way, Drew, have you ever had goat milk?
Fresh, yeah. There's a place in Mornington Peninsula, a place called Red Hill. Oh, yeah. That's delicious goat milk.
Okay, great. Well, it's a goat milk is actually a pretty good alternative for people that react poorly to cow's milk. But so that's just one part of the business, but it's really that infant formula push for the more organic style products going into China and that type of stuff. And we don't really need to explain what's been happening between China and everyone else recently.
That's another podcast.
And that's another series. So this is Bubs' result. Gross revenue up 32%. If you take actual revenue, up 24% to 55 million. Infant formula revenue up 58% to 19 million. So a bit over a third. A loss reported of 16.1 million, which was up from a loss of 35 million the year before. The thing that makes this probably, like, I still own this business, by the way, so it's not like I've sold it or anything, but the thing that made this report bad for me is that in the lead up to the report over the last few months, they made a lot of market sensitive announcements, which I would call promotional. And there was lots of fluff, lots of dot points, but not many silver bullet points. Like
no dollar figures.
It's like, okay, great. You've got a brand ambassador. Wonderful. Okay. You've got this new joint venture going on. Wonderful. Tell us, what's it going to cost us? What's the opportunity here? And so that's kind of I was already, I don't know, maybe I felt it in my waters, Drew. You get this feeling, like sixth sense. If you've been in the market long enough, you can kind of sense something might be coming. And for me, that's what we saw here. And then on the last day of reporting season, it reported, and it went into
that's a bad sign too.
Bad sign, yeah. You typically find companies are eager to release good results and a bit slow to release bad results. That's just a generalization, right? Don't go out and trade on that or anything. But the last day of the month, then it went into a 4-day trading halt. And they released their annual report, and all these statements. I think it was over 50 pages of reports, and none of them mentioned the capital raising. It was just that standard ASX, can we have a trading halt? And I was like, well, okay. So that says to me, if they've released the note saying we want to be in a trading halt, but they haven't mentioned it anywhere else in all of these annual reports, and there's no conference call, or at least I couldn't find one, that says to me they don't know exactly how much they're going to raise or how they're going to pitch it.
Yeah.
So that was frankly, it really annoyed me. As a shareholder, that type of uncertainty, it's important to your understanding.
Was this an issue with the canning facility? Is that what Bubs was?
I don't think so. I think this was just more like the China strategy had changed very quickly. Yeah. And so they're going for like a new route to market with a new joint venture partner. And maybe it's one of those...
Like Daigous have dried up.
That's it. That's exactly right. So the route to market has changed, and they're 49% ownership in a joint venture partner in China. Anyway. So I had to find out, and our members had to find out, that the company was doing a capital raising for a certain amount of money from reporting in the Australian Financial Review, which says to me again, if that had leaked from a fund manager or an institutional investor who got that memo, that it was being shopped around a bit. Yeah. It hadn't. It shouldn't have happened, in my opinion. And so here we are. We've got it's Thursday, we're recording this. We got the numbers, and it looks like it's doing a capital raising at 80 cents, or 13% less than what it was trading at last week. It's going to be a share purchase plan and an institutional component, as always. I might just top this off with, when you look, this is more for an educational perspective for people watching or listening. When you look at a company, you've got to really be careful with the language that's used. It's probably the most powerful insight that you can get into a management team and the quality of a company by just studying the language. And this is just a snippet I've taken. So this is a quote. I can't remember who said it, but it was in the report. It said, "We can see pathways for the company to an aspirational revenue goal of $400 million and gross margin floor of 40% by 2025. So we can see pathways, aspirational revenue, 2025.
Is that on Instagram, or was that?
That's a picture of someone looking over a cliff, and it looked great. And no, but seriously, when you look at that and when you break down the words used, you've got to be very probably cynical is the wrong word, but it's probably right. Maybe critical is the way I describe it. Is be very critical of language, because this is a signal that you as an investor have to interpret. And if you kind of just read it, not seeing what's between the words or between the lines, you miss some of the important details and nuance of what management say. So we still own this business. I think it's a business where if things go right, it's going to go really well, because we've seen that with the likes of A2. If things go bad, it could go really bad. We've seen that with Bubs with Bellamy's. So, we still own the business, and we'll see how it goes from here. But that's probably one of the losers from reporting season, given that it reported on the last day and announced a capital raising and a trading halt. So that's that, mate.
Yeah, a good lesson would be, particularly with buy now, pay later after PayPal's announcement, is kind of position sizing. If you are going into the likes of Bubs, even AMP, you don't put 10 or 15% of your portfolio into these more volatile companies. So
you make a good point.
Position them appropriately. That's the financial advisor coming out.
risk. No, it's an important point. And I knew going into this, and I made it abundantly clear to our members too, that this is the highest risk position I'd ever recommended or provided research on. So it's definitely one of those that you do see. It's the way I think about it, Drew, is if you have a number of really risky positions, if the payoff, if your probability is say 20% that there's going to be a 10-to-1 return, you'd take that, right? You just get a basket of them and you take it. But if you do take that approach to your investing, sooner or later you're going to have those investments that don't turn out. That 80% probability actually plays out and you don't make money. So this could be one of them, but like I said, I still hold it, so still just carefully analysing it. But anyway, mate, that's a great chat. We went on for a bit longer than we expected.
As usual.
It's good fun. So maybe we'll be back next week. If people write into us and tell us that they want us to keep doing it, please do. We probably need the motivation. It's great fun though, so just let us know if you like it, what you do and don't like, and it really helps us. Drew Meredith, Wattle Partners, financial advisor. Get in contact with him, folks, if you looking for financial advice and structures around model portfolios and that type of stuff. Drew, as always, mate, thanks for joining me.
Thank you. Enjoy the new place.
Yeah, cheers. Lots of work to do.